speaker is Meltem Demirors. I missed her so much last year because the energy that she brings and the information was completely lacking last year. I don't know how we survived, but we've tempted her back. How have we tempted her back? By the slopes. She actually grew up skiing in the Engadine. She probably knows this area better than most of us, but we've tempted her off the slopes and hot off the press. She's about to do a keynote technology, which is industry overview of the last and the next 12 months. She helped to build the digital currency group and now leads investment and strategy at CoinShares, a global digital asset manager with 1 billion in assets under management. Please welcome Meltem to the stage.
I missed everyone last year. My first year here, I actually came from a car straight to the stage, and I think I ended up speaking every day on different topics, so I have very fond memories. And I will confess, I did hit the slopes this morning, so I have a little bit of a goggle tan. I forgot to wear sunscreen, so if it starts showing, that's why. All right, so we have 30 minutes, and what I thought we would do, recently I published a trends report. It's 140 pages long, lots of charts, lots of data. But I thought today what I would do is tell a little bit of a story of what we talk about in this trends report, which is what's happened over the last 10 years, what's happening right now in this industry, and where might we go the next 10 years. I've been investing professionally in this industry for the last 5 years. CoinShares manages assets on behalf of investors. As mentioned, we have passive trackers under the XBT provider brand that are available here in Europe. We have active strategies for sophisticated investors, and then we have a capital markets team that's in the market trading and supporting a small group of clients. We have a robust platform. One of the reasons that we are able to do what we do is we have a broad product offering. We have a robust team. We're regulated in 7 jurisdictions, so all of the policy talks and compliance and regulation talks you're going to hear, we have lived through all of that. It's quite the hurdle. And then we have all of the back office functions that you would expect from a professional asset manager. And then the last thing I'll share is sort of our view on where Bitcoin fits into a balanced portfolio. We provide a number of these services. There are other ways people are getting exposure, but we believe one of the reasons I'm here to talk with all of you, and I think many others share this view, is that Bitcoin has a role in every investor's portfolio. That's certainly my belief, and I'm happy to chat with any of you about what that looks like, how we think about that, etc. So that's my short overview of CoinShares. So let's get to the good stuff and why we're all here. So there are going to be 4 key sections. I'm going to go fast, but you're all very clever, and I'm sure that you will follow it no problem. We're going to talk about where we've been. We're going to talk about where we are now, broader macro trends, and then where we're going in this industry. And I think we're living in a really interesting time. If you read the news, if you pick up a newspaper, there's a lot happening in our world, and a lot of it is happening outside of this industry. And there's also a lot happening in this industry. And I think sometimes where we fail to connect is where those two intersect and how what's happening in the macro world's impacting what's happening in crypto, and vice versa, how what's happening in our industry could potentially shape what happens in the broader world over the coming years and decades. So with that being said, shall we dive in? Are you ready? Yes? Okay, good. Some enthusiasm. I like it. All right, so Bitcoin's been around for 10 years, and it's been a slow evolution. One of the models I really like is from a book by Carlota Perez, which is about technology and financial capital. And what this orange line is the price of Bitcoin. And last time I was at this conference was at the peak of that red line. It's when we hit an all-time high. So we saw this emergence of Bitcoin. There was a lot of funding in the last 5 years. The last 2 years saw a lot of rampant speculation where we went from smart investing to just throwing money at the casino. And I think some of us in this room lived through that and experienced that. And now the phase we're going through, there's been a realignment of expectations. And I think people recognize it's going to take time for this technology to develop, and it's going to take time for it to mature. So expectations are much more realistic. And I think the type of activity we see now, much more connected with legacy capital markets, much more connected with the reality of how people invest, how people allocate assets. So last 10 years of Bitcoin, what we've seen, we started really with consumer Bitcoin. So many of you are probably familiar with some of these names, and some of them you may not remember because they don't exist anymore despite raising lots and lots of funding. So the first wave of Bitcoin was consumer-oriented. How do I buy Bitcoin? How do I store Bitcoin? How do I trade it? That was it. We had some payment processors, and a lot of the solutions we had were focused on self-custody. Now we're in a new phase, what I like to call institutional Bitcoin, although arguably we're not quite hitting the institutional market yet. And what we're starting to see is some of the players from consumer Bitcoin world have crossed over, and some haven't yet. And it'll be interesting to see in the next decade what brands stay, what brands evolve, and who the leaders will be. And I think the next phase we're going to see is building banking and financial institutions around Bitcoin. And I know here in Switzerland, there are a lot of institutions that have bank charters and are starting to build an integrated suite of financial services, deposits, insurance, lending, investment products, payments, et cetera, all around this emerging ecosystem. And so it'll be exciting to see what happens here in this country and also in other parts of the world. But what we've also seen is we've moved beyond Bitcoin. So you've noticed probably the only word I've used in the last 5 minutes is Bitcoin. Bitcoin, 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 Bitcoin. It's because I'm very excited about Bitcoin. But there's also a lot more than just Bitcoin. And when Bitcoin started, it was a really small market. When I started working in Bitcoin professionally, the market cap was around $200 million. Today, it's closer to $200 billion. So a very different time. But what happened after Bitcoin started gaining more awareness is people wanted to build on the idea of Bitcoin, and they did it through initial coin offerings. So Ethereum is probably the best known successor to Bitcoin, or sort of next follower. But there are a number of different projects that launched with varying degrees of success, varying degrees of legitimacy. Banana coin is one of my favorites. The idea that you could have a token that represents bananas is pretty entertaining. And then we went into this phase of tokenized securities that we're still in. We have stablecoins as well. And the phase we're starting to see now is the idea of Fed coins, or government-issued digital currencies. And I think someone was just on stage before this talking about such an idea. But really what's interesting here is the addressable market with each iteration gets much and much bigger, right? Potentially consuming all of M1, M2, the entire monetary supply. So while Bitcoin has defined this industry, digital finance, or this idea of digitization using some of the elements that Bitcoin introduced to the world, is very, very popular today. One big thing we learned is ICOs are not like IPOs. They're not like IPOs at all. So what you see here is the prevalence of different types of funding, how much has been raised via IPOs, which are the light blue line, venture capital, which is the dark blue line, and then ICOs, which are the green line. So ICOs initially were poised to disrupt capital formation. Everybody was talking about the death of IPOs. Hasn't happened yet. Doesn't mean it won't. Other trend, fat protocols are still an investment thesis. I don't know how many people in this room invest in digital currencies that are more speculative or younger in nature. But as you can see here, token generation events, or ICOs in the dark blue, far exceed the capital raised by conventional funding. And that's still true today. It'll be interesting to see what happens in the year 2020 as more of these projects come to market and as investors start to realize whether or not these things are going to yield some of the returns they expect. However, many industry investors are fundamentally long these new protocol tokens, in addition to Bitcoin and other cryptocurrencies, so that's been an interesting development. We'll see how this strategy fares. Here again, you can see in dark blue how much the top 10 ICOs raised, and in light blue, the current market cap of these tokens. One of the biggest projects we're watching right now is Telegram, raised $1.7 billion. Uncertain if the project will launch. They're facing a lot of regulatory challenges, but there's certainly a string of others. Tattoo most famously raised $600 million. The project is no longer alive. So very interesting to see if the strategy pays off. But IPOs, right, the other fundraising mechanism, are also in a state of flux. We can't talk about capital raising without talking about the interesting year we've had in the IPO markets. WeWork, obviously, don't need to say much more than did not meet expectations, was not able to IPO. Uber has had a really rough year after their IPO. Market's down 40% from peak. Lyft has had a tough time, and there are a handful of others. And what we've found here is that business models really matter. Pure software has done much better than consumer tech. And we're going to talk a little bit about why I think that is. But there is this broader shift from physical to digital because the margin in digital is massive. And in physical, there's a lot of components to manage and costs are much harder to control. So that's where we've been. Does everyone roughly agree with that being sort of the state of play over the last 3 or 4 years? Yes? I see nods. Okay. So where are we now? I want to talk a little bit about the macro perspective, what's happening in the world. Now, there's two key trends I want to talk about here. The first one is financialization, because we live in a world where money is free. Money costs nothing. We print it, we give it away. The cost of financing for most firms is effectively zero. So everything's getting financialized. And then I want to talk about digitization, which is the move away from companies owning physical infrastructure, owning physical assets, to operating more in the digital realm and dealing with more intangible goods, and the idea of connectivity as more and more of our interactions move online. Sound good? All right, I'm going to go for it. So one interesting thing to look at, 2009. In 2009, I worked in the oil and gas industry, and I thought I was in a great industry. Because in 2009, the largest companies in the world were primarily oil and gas companies. There's one software company up there. There's a company who sells stuff, Walmart, and there were a few financial institutions. Together, they had about a $2.3 trillion market cap. Today, the 10 largest companies are software companies. They're tech companies. You have Microsoft, Amazon, Alphabet. You have two financial institutions, Visa and JP Morgan Chase, and you have an investment firm, Berkshire Hathaway, that invests in other companies. Together, these 10 companies have almost 3 times larger market cap than the largest companies did 10 years ago. So the two trends here that I think are interesting is, number one, these large companies no longer own physical infrastructure or sell physical goods. And number two, as we can see, they've been highly financialized. And we'll talk about that some more. So where I think it gets really interesting, if we think about how tech has developed to date, we have open protocols that got built on the internet, but captive networks. If you look at the way we consume digital services today, everything is proprietary. You have to pay to have your app listed on top of any platform, and the issuers of these platforms, the people who run them, exert heavy influence over app distribution. Many apps in our industry, the crypto industry, have not been able to list on the iOS store, the Android store, and reach distribution through this channel. Platforms restrict access, and they limit the ability of third-party developers to build on top of their platforms. Companies usually prioritize proprietary applications, So if you're a third-party developer, your app is going to get pushed to the bottom. And if you're a startup, you're competing from a disadvantaged position. And so what I find so interesting is when we talk about the internet, one of the biggest value propositions of the internet was the value of this global network of connectivity that we were building. But today, this network is owned and controlled by private companies. By the way, some of them are the companies here that are the most valuable companies in the world. They own how we experience this digital world. And so what I like to say is, welcome to 2020, where you live at the mercy of your digital overlords. There are 5 companies in the US that comprise 15% of the S&P 500. They are Microsoft, Apple, Amazon, Google, and Facebook. And so when I think about my experience as a consumer, I wake up every morning and I look at my iPhone. That's an Apple product. I check my email. I use Google for my email, but I'm consuming it through Microsoft Office interface. I'm using Microsoft. I order my groceries and all of my household goods on Amazon. I consume content through Amazon. And even though I'm not a Facebook user, I talk to people on WhatsApp. So Facebook knows where I am, has my data, knows who I'm talking to. My life in the digital world, everything I do on my phone and on my laptop is known to these 5 companies. And while the digital economy is growing, the growth has been disproportionately captured by these few companies. So the premise that starts to get really interesting around Bitcoin and what we're doing here is the idea that we can have both open protocols and open networks. And so what I think is an interesting sort of analogy, when the internet first emerged, a lot of the people were talking about the internet potentially killing companies. And what we've seen is the internet hasn't killed companies. A lot of the companies that existed 20 years ago still exist today. But what the internet did is enable new types of companies to grow and made existing ones more agile, more efficient. And so it's my view that what we're going to see over the next 10 years is that Bitcoin and open financial systems are not going to kill financial institutions. Banks are still going to exist. But what it will do is enable new types of companies to grow and make existing financial institutions more resilient. My view, one person's view, I'm happy to debate it after. So the idea of open protocols and open networks, I'm going to talk about Bitcoin because it's what I find most interesting. Bitcoin is an open, permissionless financial network. Anyone can join the Bitcoin network, anyone can leave, anyone can build on it. The Bitcoin blockchain is a global settlement system for all of the transactions that happen on this network. And you're not stuck on any one application. If you buy your Bitcoin on Coinbase, you can move it to Gemini custody if you like. You can take it and put it in a wallet that you own. It's your asset, and you're not stuck on one platform or in one application. You have the ability to freely do what you want with your Bitcoin. Today, maybe that won't be the case 5 years from now. And users can either interact with the network directly, or they can use an intermediary to minimize risk. There's choice, which I think is really helpful because choice is something that matters to consumers and should matter to all of us. So my view is that with Bitcoin, companies can deliver financial services at a fraction of the cost. And so Bitcoin has the potential to do for financial services what the internet did for software development. That's a bold claim, and I'm willing to stand the test. So where are we going? What's going on in crypto land, and what are we talking about? So the first move that I think is interesting is a little bit of macro theme, but it's the move towards the digitization of finance. So in 2009, we started investing in companies that fit into the FinTech landscape. And what this was is startups building new ways for people to consume financial services. And typically, it started with consumer, but FinTech companies have since started eating to different parts of the banking stack, moving into enterprise banking, small to medium enterprise banking, lending, and all of these different verticals. Then we started moving into Techfin, which is the inverse, which is where tech companies started becoming banks. And that trend still continues today. Apple's trying to launch a credit card. Amazon has a checking account that they're offering. So this trend of Techfin actually started in Asia with the internet giants like Alibaba and Tencent, who now have some of the most widely used financial services platforms in these markets. Then in 2016, here in Europe, we saw this trend towards something called open banking. And the idea here was that banks should open up their infrastructure stack and allow people to build applications using the bank's data and allow people to develop new offerings or improve the customer experience. Then in 2017, everyone started talking about blockchains. And I'm sure that many of us heard the narrative that blockchains were going to kill banks. If you recall, companies like R3, Digital Asset, and others claimed that banking would be dead in 5 years and everything would be done on a blockchain. Well, 3 years later, here we are. We're not doing much on a blockchain yet. Doesn't mean we won't. But that was the narrative in 2017. And then in 2018 and continuing into 2019 and this year, we've seen this idea of open finance. Some people call it decentralized finance. I like the term open finance. But I think the idea here is that for the first time, we can transmit value in ways that are not constrained by traditional physical borders. And this is a really powerful idea. When I think about the fact that I can, in 10 minutes, send a Bitcoin to anyone, anywhere in the world, using just an open source client, you've never been able to send value that way before. And so this move towards open finance, there's a lot to figure out. There's a lot of work to be done. There's a lot of challenges about fitting it into the existing regulatory framework we have, but people are pretty excited about it. So if we think about what's happening here, we see people taking parts of the finance stack and changing them to fit into a crypto native world. So if we look at what's happening, we see people building exchanges, things like stablecoins, building lending contracts that don't require an intermediary, building asset management contracts that don't require people to set up asset management firms. I think Mona from Melon is here. She's building something in this vein as well. We see people building decentralized derivatives, building different types of tokenized contracts, and then they're also building the user experience stack. So what you would experience with your traditional bank, a user interface, fiat to crypto connectivity, and commercial banking products. While there are a lot of firms that are building in the DeFi or open finance space, there are going to be a lot of regulatory challenges, and this is something that we spend a lot of time thinking about working on at our firm. And at the end of the day, if we look at centralized finance versus decentralized finance, centralized finance is by and large the winner. What you see here is the market cap of Tether, which is a stable coin that's managed by a central intermediary. And here is the total value locked in DeFi. It doesn't reflect the 100 million that was added in the last 48 hours because we've seen a massive uptick, but it's still dwarfed by the amount of capital going through centralized finance infrastructure in the crypto space. Doesn't mean it's going to be that way forever, but being very realistic about some of these challenges. Stablecoins. Everyone loves them. Everybody wants to talk about them. Why do they exist? Stablecoins do this. This is a big chart. But basically, instead of waiting 3 to 5 days to deposit cash at your financial institution, wire it to another institution, clear your trade, what you can do now is move cash collateral on the same network where crypto assets move. So it's effectively a technology solution to allow trading to happen on the same settlement medium as the assets you're trading. And what this does is it reinforces this idea that blockchains can be effective settlement networks. What this means is stablecoins have grown tremendously in usage and in volume. So what we see here is the overall market for stablecoins. It's grown almost by 3x over the last year. But what's interesting is Tether is still the undisputed king of stablecoins. A lot of people have concerns about Tether, which is the most popular US dollar stablecoin in issuance today. People have attempted to create regulated alternatives, but I think there's a clear sort of early winner here in the stablecoin market, and it'll be interesting to see what happens over the next 5 years. Tether is facing a large lawsuit, and so we'll see what the regulators do. All right. Moving right on. So financial institutions are also getting involved in the crypto game. And this is what's really interesting, because 3 years ago, if you would have told me that financial institutions were touching Bitcoin directly, I would have told you you're crazy. And today, there are a bunch of financial institutions that are touching Bitcoin directly. You have Square. You can buy and sell Bitcoin in their Cash App. You have CME Group offering cash-settled Bitcoin futures contracts. And as of last week, they launched options. You have Fidelity offering Bitcoin custody and Bitcoin trading. They're investing in companies, and they're running their own Bitcoin mining facilities. New York Stock Exchange's parent company, ICE, created a new subsidiary called BACT that issues digitally settled Bitcoin futures. Bloomberg has data feeds. They have the Galaxy Bloomberg Crypto Index that anyone can access, and they have a lot of price feeds for crypto products available on every Bloomberg terminal. It's pretty impressive. And then TD Ameritrade is working with ErisX, an institutional exchange, to bring crypto trading to their customers. This is just a small example of what's happening in the world of traditional finance. And I think that's really exciting that those bridges are getting built. Blockchain hype has finally come back down to earth. So if you recall, there was a lot of talk a few years ago about blockchains killing banking. What we've seen is a lot of the large companies that were pursuing this have changed direction and are no longer working on building bank infrastructure, but instead are spending a lot of time building things in the cryptocurrency space instead. And what matters most, what I think is really interesting, business models, right? People need to have a way to make money. So if we think about the internet, what's so fascinating about this analogy is what mattered in the internet was advertising. Advertising was how people monetized the internet. And so what people cared about is eyeballs, meaning how many people were looking at your stuff, and clicks. Clicks meant you had engagement, and you could convert that engagement into sales. And power in the days of the internet came from having the most data to sell, which allowed you to better target ads to people who might ultimately buy a product. So what drives business models in the world of Bitcoin? Transactions. And this is where it gets interesting, because the metrics that matter most is how much volume goes through your platform and how much revenue you're able to make by extracting a component of those transaction fees. And your power as a firm comes from having the most ways to extract fees. So while the early internet was about monetizing eyeballs via advertising, crypto companies today are financial intermediaries. So if we look at the most valuable companies in the space, they are exchanges: Coinbase, BitMEX, Kraken, Binance. Trading firms, financial intermediaries, are the most valuable companies because they have a lot of volume flowing through them, and they're able to charge a sustainable margin on those products. So I think that's just something interesting to keep in mind. Whenever I talk to companies building new products, my question is always, well, how do you make money? And if the answer is long and complicated, it probably means that it's too complicated for simple me. So the flavors of crypto business model, there are people who build products, people who build platforms, and people who build infrastructure. But what we're really looking at here is how do you build scalable revenue model where firms can make money even when the price of Bitcoin is $5,000 or $20,000. And historically, we haven't seen that. Things that haven't made money, consulting, professional services, and the creativity of people to try to monetize business in this industry has never ceased to amaze me. Banana coin's a great example. Somebody owned a banana farm and wanted to make a coin and sell forward their bananas. I think there's a sardine ICO happening right now where someone's selling tokens that entitle you to a can of sardines. So who knows? People are very creative. More power to them. I just don't think it's that interesting. So I'll skip through this, a lot of detail. The last thing I want to talk about that doesn't get talked about enough is derivatives. So a lot of times when people talk about Bitcoin, their view of the market is that everyone's going to buy Bitcoin spot, meaning on the open market, and they're going to be fundamentally long Bitcoin, meaning they hold Bitcoin and think over the long run it will go up in price, hence good investment. But there is a decoupling that happens when you introduce derivatives to a market. So it's interesting to look at is the gold market, right? Gold for a long time was primarily traded physically, meaning over the counter. And then the gold futures market started to take off. And what's interesting is when you start creating derivatives, you're no longer tied to the supply limitations of the underlying. So while there are only 21 million Bitcoins, you could create a number of synthetic contracts for Bitcoin long, Bitcoin short, that are just financial contracts between two counterparties that can trade. It's exactly what happened to gold, where now the futures volume of gold is 30x the volume of the physical gold that gets traded every year. This is called financialization. It's happened in every market, and Bitcoin is not immune to it. I started my career trading oil and gas derivatives, so I've seen it happen before. And if you look at what's happening in the market today, Bitcoin volumes on the derivative side are growing. If we look at these platforms listed here, there are close to $4 billion of traded volume that we can find that are reported every day across the top exchanges. Huge amount of derivatives volume. And my belief is that over the coming decade, we're going to see this grow tremendously. Because if I can bet on the price of Bitcoin without having to hold the underlying, that's going to be an attractive trade to a lot of people. And if we look at what's happened to the CME Bitcoin futures contract since launch, it's grown consistently. So let's put it all together. I've been talking for a while. You're like, Meltem, please stop. Too much data, too much information. I apologize, that is my style. I will share these slides online so you can review them in your own time. Here's the big trend. Finance is eating everything. The value of corporations over the last 20 years has increased significantly faster than GDP, meaning that returns to capital, returns to money, are growing faster than returns to labor. We're creating more money than we produce value. And you can see that taking off right here when quantitative easing started happening, right? The value of the S&P has far outweighed the value creation by GDP. So finance is eating everything. And the frontier of finance, in my view, over the next decade is payments. Payments are moving online. If we look here on the chart on the left, cash payments are declining significantly. Credit card payments are staying fairly flat. Debit card payments staying flat. Mobile payments and e-wallets are going to command a significant share of the payments market. And the biggest market is the APAC market. So that's pretty interesting. I think there are going to be a number of people over the next few days talking about what's happening in the APAC market and sharing their expertise. I'm not an expert. But the next wave of FinTech, it's not going to be led by banks. It's going to be led by digital-first technology companies who are going to deliver services to you via devices, your phone. And if we look at the volume that's going through these platforms today, it's growing exponentially. So the future is not banks. The future is financial technology delivered by the existing things. You have a supercomputer in your pocket. You probably already use it for payments most of the time. This is where we're headed. And if we look, social networks are becoming the new payment networks. If we look at the world's largest mobile payment platforms, if Libra launches, it will be by far the largest with close to 3 billion users. WeChat has a payment platform. They have over 1 billion users. Alipay and Samsung Pay, same. By the way, all three of those are in APAC. You have Apple Pay, PayPal, Amazon Pay, and Google Pay here in the US. And if we look at markets where that growth is going to happen, China, Mongolia, then you have Kenya, Chile. So there's growth happening in emerging markets, and these mobile payment transactions are going to be worth a lot. And I think it's interesting to see that telcos are going to be the point of distribution. So Samsung has a cryptocurrency solution embedded in the Galaxy S10 phone. Apple rolled out a crypto kit that contained developer tools. HTC has really embraced crypto. They have a crypto phone that they released that provides a full Bitcoin node on the phone that you can run. And AT&T is now allowing people to pay their bills using crypto via a partner, BitPay. So I think the most exciting channel for what's happening in this industry is going to be payments and the use of mobile devices. And maybe in the future, we will all trade, buy, sell, interact with one another through social networks using cryptocurrencies. This wild, crazy future we'll live in. It's going to take time to build trust. If you look at trust that people have in financial services, cryptocurrency is the lowest, right next to robo-advisory. So we have some work to do to restore a lot of the trust we lost in 2018. But over time, as we build better experiences, the hope is that more users will trust use of cryptocurrency for financial services. And I have one more thing to say. Finance and tech, both industries want in. Facebook's developing a coin. JP Morgan has a coin. There are a handful of others. So this is going to get very political very quickly because money has always belonged to the state. And all of a sudden, it may not belong to the state anymore. But what I'm excited about is there are also tools for the resistance. So if you don't want to live in a world defined by your digital overlords, there are a number of different companies that are providing products and services that allow people to protect their personal privacy and freedom of expression. I'm a big fan of some of these solutions. There are a number of others, and I know Elizabeth, when she talks about Lightning, we'll talk about some of these themes. But anyways, this is what I think is interesting, what's exciting. There's a lot of important work happening in this industry. It's starting to converge with policy, politics, finance, social trends, global macro trends, and it's going to be a fun next 10 years. So excited to be on the ride with you guys. Thank you.